Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Tuesday the 9th of December. I'm Caroline Hepke in London.
And I'm Stephen Carroll in Brussels. Coming up today, the US media giant Paramount makes a hostile bid for Warner Brothers Discovery, challenging rival Netflix.
European leaders grow closer to an agreement on using frozen Russian assets to back Ukraine.
Plus, the billionaire family behind Volkswagen risks delaying the carmaker's recovery amid strained cash flows.
Let's start with a roundup of our top stories.
The US media giant Paramount has launched a hostile takeover bid for Warner Brothers Discovery, just days after the company agreed to a deal with Netflix. The offer stands at $30 a share in cash, compared with Netflix's cash and stock bid of just under $28 per share. US President Donald Trump, whose son-in-law Jared Kushner is participating in the Paramount bid, has downplayed his involvement, saying he's not close to Paramount or Netflix.
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine.
President Trump speaking there from the Oval Office. Now, Paramount wants to buy all of Warner Brothers, while Netflix is seeking only the Hollywood studios, HBO, and the streaming business. If Paramount's bid is successful, it wouldn't need approval from the FCC or Congress. Its combined shares with Warner Brothers in the streaming market would be lower than in the Netflix deal, according to Bloomberg Intelligence.
Now, European leaders are growing confident they will reach a deal to use frozen Russian assets to back a €90 billion reconstruction loan for Ukraine. But there is still a gulf between Ukraine's European allies and the US on providing security guarantees for Kyiv to protect the country from future Russian aggression. It comes after talks in London with the leaders of the UK, France and Germany, and Ukraine's President Volodymyr Zelensky, who emphasised cooperation.
Things which are very important, I think, unity between Europe and Ukraine, and also unity between Europe, Ukraine and the United States. There are some things which we can't manage without Americans, things which we can't manage without Europe, and that's why we need to make some important decisions.
Ukraine's Volodymyr Zelensky there, who left London to head to Brussels and on to Italy today. The next stage in the plan on frozen Russian assets is a leaders' meeting in Brussels on the 18th of December.
The US President has given Nvidia his approval to ship its H200 AI chips to China in exchange for a 25% surcharge. In a social media post, Donald Trump said the Chinese President Xi Jinping had responded favourably to the move, which could see the world's most valuable company regain billions of dollars in lost business from a key global market. Here's Bloomberg's Annabelle Drewlers.
This is actually the sharpest pivot we've seen yet on China's access to this technology. I think the key question and what we've been discussing all morning is really, even with H200 sales, will Chinese companies be allowed to purchase? They weren't allowed to purchase H20, but at the same time, H200 is a significantly more advanced chip than the H20, which was designed specifically for the mainland market.
Donald Trump added that shipments would only go to approved customers and that chip makers such as Intel and AMD would also be eligible. Democratic senators, including Elizabeth Warren, have criticised Trump's move, warning that giving China the new chips would be a colossal economic and national security failure.
Now, Unilever's new spin-off, the Magnum ice cream company, was valued lower than some analysts expected in its debut on the Amsterdam Stock Exchange. Magnum shares closed at €12.97 each on Monday, giving the company a market value of €7.94 billion. Shares also debuted in London and New York as part of the triple listing. Bloomberg's Freddie Fulston has more.
At just under €8 billion, the market cap of what is now the world's largest standalone ice cream company came out lower than analysts expected on Monday. Magnum, which was formerly Unilever's least profitable division, wants to use its new independence to focus on growth amid an uptick in health-conscious consumers. The company's CEO said Magnum needed to grow 1% to 2% faster. Analysts at Jefferies assume a more settled price won't be established until at least next week. In London, Freddie Fulston, Bloomberg Radio.
US Treasury yields climbed to the highest in more than 2 months on Monday. It comes amid a slump in global bonds ahead of the Federal Reserve interest rate decision tomorrow. Some traders have warned the US Central Bank may signal a slower pace of easing ahead. Traders now see a roughly 90% chance that the central bank will deliver a third straight quarter-point reduction to interest rates to a range of between 3.5% and 3.75%. 10-year Treasury yields up a basis point this morning at 4.17%.
Black Friday discounts failed to prevent a slowdown in UK retail sales, adding to evidence that speculation of tax rises ahead of the autumn budget damaged consumer confidence. A report by the British Retail Consortium shows total retail sales increased by just 1.4% year on year in November. That was below the 12-month average and the weakest pace since May. The CEO of the group, Helen Dickinson, said that pre-budget jitters among shoppers meant the month of Black Friday did not deliver as strongly as retailers had hoped.
Well, those are your top stories on the markets. The MSCI Asia Pacific Index is down by 0.5%. The Hang Seng's 1.3% lower this morning. Tech shares are weighing on that index. The Hang Seng Tech Index down by 1.9%. European stock futures a little softer this morning. Pretty flat on Wall Street. We talked about Treasury yields rising further today. Bloomberg Dollar Spot Index flat as Fed policymakers go into their decision. The euro a touch stronger at 116.43.
Those are the markets. In a moment, we'll be discussing why the family controlling Europe's largest car maker is worried about dividend payments. But before that, want to get to our top story. This is the bidding war for Warner Brothers Discovery. Paramount Skydance has now made a hostile bid of $30 per share in cash versus Netflix's offer in cash and stock. Manuel Baigori, who leads our deals team in Asia, joins us now for more. Manuel, good morning. There are 2 bids on the table. What happens next?
2 bids on the table, indeed. What a fascinating story. What a fascinating deal that we have here. It's just tremendous, right? It's just, all the ingredients, all the great ingredients that we as journalists and observers want to see in a magnificent deal of this caliber. What's next? Well, there is a bidding war. And as in any bidding war, the next steps, the next few days will be key. Paramount has said that they want to give 10 days for Warner Brothers to evaluate the proposal. Obviously, 2 different proposals on the table. One for the whole company in cash by Paramount, the other one for some of the assets combining cash and stock by Netflix. Now, obviously, there is a lot of work behind the scenes with investors, banks. Obviously there is a political angle here, a regulatory angle as well. So it's just a lot of moving pieces. It's a little bit hard to say how this one is going to play out. But obviously, even Donald Trump, right, made some comments to the potential problem, so to speak, that a deal with Netflix may encounter from antitrust. So one wonders whether, that gives some wiggle room for Paramount to make their case. And obviously now the big question mark is like, if you're a shareholder of Warner Brothers, do you want to take the cash, the superior offer for the whole company, or do you believe in the potential Netflix combination, cash and stock? And obviously Netflix has been a growth story for many years, and obviously Warner Brothers would spin off some of the assets as they previously disclosed. So 2 different proposals. I guess there is going to be a lot of back and forth also with some of the key investors, and a lot of education, right, from both sides to explain the merits of each bid.
Yeah, indeed. And you mentioned those key antitrust issues as well, which will be in focus too. We've also been reporting, Manuel, on how the story of the Paramount bid came together, and it involves Jared Kushner, the son-in-law of President Trump.
Yes, indeed, and his firm Affinity Partners. They've been very active on various deals. We've seen them popping on more and more deals. The reality is, obviously, there is a political angle here, and also bear in mind that there is, a few Middle Eastern funds. We've seen Qatar Investment Authority, a fund from Abu Dhabi as well, also backing Paramount. Obviously, there is like some prominent investors like Apollo, banks, Citigroup, Bank of America, also backing the bid as well. And, you've got other high-profile names like Redbird Capital Partners, also Larry Ellison, which at some point this year was the world's richest person, also backstopping some of the financing there. So some really big names. There is definitely the more broader geopolitical angle into it as well. Just tons of great ingredients for a fascinating story to follow. But it's gonna be interesting to see how Warner Brothers responds to this, because obviously they also on the board needs to respond to the ultimate benefit of what's best for shareholders, right? So that will be definitely the key to any transaction bid. Ultimately ends up being superior, and now obviously there could be other moves, right? Like what if Netflix makes a move and tries to increase the bid, or whether another counter-bidder shows up. Obviously there's been reports that Comcast also was looking at it, so there could be other interesting twists and turns on this situation. Again, I think the next few days and weeks will be quite critical. And then, needless to say, the regulatory approvals, that could be a bit of a bumpy road as well.
Yeah. Some of the observers saying that this is really all about the future of Hollywood, of what is going to shape this kind of entertainment landscape in the US. Manuel, thanks for being with us. Manuel Baigori, who leads our deals team in Asia, covering the bidding war for Warner Brothers Discovery. Stay with us. More from Bloomberg Daybreak Europe coming up after this.
Before we get into our next story, Caroline, I just wanted to mention something that I've been reading this morning from our food editor, Kate Crader, as well. She has a warning, more for you than for me, actually. If you're planning on going essentially anywhere in London before Christmas, if you haven't booked, good luck finding a table now. She's been looking at some of the polling data, which says that people in London are actually eating out less, or people in Britain rather are eating out less because of cost of living concerns compared to a year ago. But actually some of the restaurateurs that she's spoken to are telling an opposite story. The CEO of Hawksmoor was speaking to Bloomberg Television recently, said bookings are up around 15% compared to last year. Other big well-known restaurateurs in London saying it's about 5% higher as well. Now, the CEO of Hawksmoor saying that perhaps this is people trying to cheer themselves up going into a Christmas season after maybe a difficult year financially as well. It's one of the things that I have to say I don't miss about London, is you do have to book restaurants very far in advance.
Yeah, I happened to walk past the Hawksmoor in St Pancras only yesterday, and I perused the menu, which actually was in a nice glass box outside. You do have to book early. I get that. If you're going to be spending big, you want to know that it's going to be lovely. Personally, I'm trying to return to the dying art of the dinner party, but I love Kate Crader's piece.
We'll put a link to it in our podcast show notes. Let's turn to another story we're covering this morning. The family that controls Volkswagen risks delaying the car maker's recovery by pushing for dividends during an overhaul. Cratering profits at VW and Porsche have put Hans-Michel Piech on edge about dwindling payments. Our German Autos reporter Monica Raymond joins us now for more. Monica, good morning. Can you first explain the background to this to us? Why are the families so reliant on dividends from the VW group?
So the Porsche and Piech families, through their holding business, they have a majority control of the voting shares at Volkswagen, and through that family holding company, they get much of the dividends that come from Volkswagen and now from Porsche. And those dividend payments have long supported the families, some 30 members. And as those dividends shrink, that means the families are getting less and less of a payout.
And so the question whether this could push to derail the recovery at VW.
Yeah, so that's the risk that Volkswagen faces right now, that this push for dividends could really slow or gum up Volkswagen's recovery. The German car industry has had several challenges to tackle, and Volkswagen really has seen some of the biggest challenges. The family's interest in maintaining dividends threatens to stall the bigger changes to make this company a lot more competitive. The issue is that Volkswagen is really under major margin pressure, not just from cyclical factors like U.S. tariffs or economic slowdown in China, but also from really changing structures within the auto industry. The car industry is switching to EVs, software is becoming a lot more important, there are new business models coming up, and a lot of this requires heavy spending and quick action. Now, the family is a bit reticent to make drastic changes because those bring risks, and those can also impact how big those dividends are.
Monica, what about the outlook from here for the company? Will some of those challenges ease over time, or what's the expectation?
So Volkswagen is making efforts to make a lot of changes, but it's really being squeezed from all directions, and a lot of these pressures and disruptions are really long-term challenges. So we're seeing, the company is facing issues in China. After the pandemic, they sort of lost sight of all of the changes that were taking part on the Chinese market, and that meant that they lost a lot of market share there, and they're struggling to keep up with Chinese competitors, essentially. Yeah. In Europe, they're facing rising energy and materials costs, higher labor costs, and in the US, we have the tariff impact. Volkswagen is expecting that the total costs are going to be about $5 billion this year.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.